welcome to today's call, looking back at 2017 and ahead to 2018. This is Catherine Barr. I'm the Director of Client Services and Communications at New Capital. I'm going to discuss a few administrative items before we get started with today's webinar. During today's call, you are invited and encouraged to ask questions. On the right of this screen, you can type in questions in chat. Leonard and Todd will answer as many questions as possible during today's webinar, and then when we're about 10 minutes left in the hour, we're going to switch to a Q&A session, and we're going to address any remaining questions at that time. And now, lastly, before we get started, I have to offer the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. Get to that screen, sorry. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you very much, and I'm turning the mic over to Leonard Golub.
Catherine, thank you very much for setting up this conference call with clients today. Welcome to everybody. Hope you're having a super day, and if you're in Houston, you're enjoying the weather. It's a gorgeous day. We are coming to you from New Capital World Headquarters, the broadcasting booth, and you should see on your screen a brief survey. So we'd like you to go ahead and take the survey. There's 3 questions. The first question, how are you currently feeling about the markets? Second one is, I think the most attractively priced securities are currently, and this is your opinion, of course. And the third question is, who is going to win the Super Bowl? So we're going to take just a second and let you all answer these questions. If you're on your computer or your smartphone, there may be some of you who are dialed into the phone, in which case you can't see the survey, so you'll just have to hang on until we get our answers. And then after this, I'm going to talk about a couple of firm update items, and then I'm going to talk about the performance of markets in 2017. Even though that's past, it can be informative. So we're going to take just a second here and have you guys answer. Again, we'll take just a few minutes. Everybody, take your time, answer the questions as best as you can. I know they're super complicated. And then Catherine will be able to see the answers. We've got just a few more people waiting on them, and then we're gonna tell you what the answers are. Okay, so question 1, how are you currently feeling about the markets? 29% of you are confident and positive. 11% of you neutral and no opinion, and a plurality of answers are concerned and wary. And I don't think that's a surprise. We're hearing some concern and wariness about the markets, and we're also hearing some confidence as well. So it's very interesting, pretty split between confident and positive, and then some of you have no opinion either. Number 2, I think the most attractively priced securities are currently, and U.S. stocks, only 9% of you think those are the most attractively priced. 52%, a whopping winner, international stocks, 52%. We've trained you well over the last year. And so 52%, more than half. 0% of you like bonds, 0% of you like real estate, and no opinion, 17%. Sometimes I don't know is the best answer to give, and so there it is. And it looks, according to the betting line here, that the New England Patriots are going to win the Super Bowl again, and that's music to Todd Centurino's ears. He's sitting right next to me, and you talk about a Patriots fan. Yep. You were talking about Todd Centurino. So we'll see in a few days whether Todd comes in tap dancing to work or sobbing hysterically.
Hard to do given the success we've had. But
anyway, and then a few of you have no opinion about the Super Bowl, and then wait a minute, go down a little bit more, Todd. And 23% of you do not care. All right. Now, without any further ado, I'm going to pull up my presentation. And some of you may have seen this presentation. We included it in our year-end reports. Actually, hang on, before I do that, let me just get to a few firm update reminders. First of all, I think everybody knows our office has moved across the street, but if you don't, our office has moved. So when you come to visit us, we're in the rose-colored building across the street now, 4119 Suite 400. And I have wonderful news to tell you, which is that we have a reserved parking space for you to park at. When you come, there's a surface parking lot right next to the building, right on Montrose. And so when you come to visit, please, that is for clients, please park there. You no longer have to deal with all the street construction that we've had, and you don't have to go down into the parking garage below grade. So we're thrilled to be able to give you that benefit. I'm parked in it today, by the way, because we don't have any client meetings today. But when we do, believe me, I will vacate. Your year-end reports, if you haven't gotten to them and want to, are available on Morningstar. We really send a very extensive year-end reports package. I'm proud of it. We also send you a tax report, and let me warn you, it's just a preliminary report. It's a tabulation and kind of a quasi 1099 that Morningstar puts out. You should not rely upon it for official preparation of your taxes, but it does give you some idea of what you will be looking at for dividend activity, interest activity, stock sales, and so on. I got a message the other day from Fidelity. All my stuff, of course, is at Fidelity as well. And I got a message from Fidelity the other day that tax reports from Fidelity are now available. So mine, at least some of them, are there. Yours may or may not be there. In the past, Fidelity has tended to get year-end tax reports to people I've seen as late February even, if they've had some systems issues. And so if you haven't gotten yours, the good news is I've gotten mine, so I'm expecting that yours is not far behind. If it gets to be mid-February or so, give us, and you haven't gotten your tax reports from Fidelity, give us a call, and we'll do what we can do to give them a call and find out when they're going to be on the way. And then this is the second of our conference calls. We had one last year, I think around April. Is that right, Todd? Yep. Todd says April. And we have talked, we have talked about making these more regular and even quarterly. So at the end of today's call, we're going to ask you some questions. Hopefully you'll take the time to answer our survey so that we can respond to what you like and what we need to improve on these calls. But we've been talking about doing these on a quarterly basis, but at least twice a year. I think we're at least committed to that. Okay, so now to a review of 2017, and so this slide really doesn't need a lot of commentary. It's my goodness, look at all the green from calendar year 2017, the year that just ended. The U.S. stock market up 21.13%. International developed stocks, Europe and Japan and Australia, 24.21%. So even better than U.S. stocks. Excuse me, I'm getting over a cough, so you'll have to bear with me this afternoon. And of course, 50+% of you answered that international stocks were of the best valuation. And so I think one of the things that Todd is going to be answering on this call in his presentation is, okay, they did very well last year. How are they valued now? Are you all just saying you like this particular category because it did well last year? And or do you think that there is more value in the future? So Todd's going to answer that question in his presentation. Look at emerging market stocks, 37.28%. U.S. stock returns were nothing to sneeze at. International developed stocks, nothing to sneeze at. But look at the performance of emerging market stocks, absolutely through the roof. And if we think back to a few years ago, emerging market stocks were actually the best performing, some of the best performing assets between 2000 and 2000 and, let's say, up to the financial crisis. Far outperforming U.S. stocks and international developed stocks. I mean, way outperforming. I don't remember the exact numbers, but it was something like, 11% a year for emerging market stocks, and developed stocks did about 2% a year between that period. And then emerging market stocks fell off the pace after the financial crisis. And U.S. stocks took the lead in the world and held the lead for a number of years. And we remained committed to international investing. It wasn't easy to keep a lot of people hanging in there because people kept saying, U.S., 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 U.S. is doing so well. And we really felt that that every dog has its day. And certainly in 2017, emerging markets had their day. Todd, in his presentation, is going to talk about what the backdrop is for all this strong performance. What's at the heart of it? What's at the root of it? Excuse me. Global real estate, not a bad year. I mean, you see what a strong year for securities it is when we're talking about 7.41%. Not so good in comparison, but won't you take 7.5% returns from an asset each year? I certainly would be happy to get that. Global real estate is U.S. commercial real estate as well as international real estate. And what you need to know about this number of global real estate in 2017 is that the U.S. real estate market didn't do that well. I think maybe broke even. So what you're seeing is strength in the international real estate market. So again, more strength internationally. And we give you diversified portfolios that include a very substantial amount of international exposure. And last year, that strategy paid off very, very well. The U.S. bond market, 3.54%. Not super, but not horrible. And the global bond market, 2.06%. A few more slides here. I'm going to skip that one. Excuse me. U.S. stocks. You can see, let's see, I think I've got a drawing tool here. Let's see if I can figure out how to use it. So, oh, look at that, I'm doing it. Up here, large growth stocks led the way. 30 point, look at me making a mess of this, 30.21%. Maybe I should forget the pencil. 30.21% for large growth stocks. So it was a very strong year last year for the Amazons of the world and the Facebooks of the world, those companies growing rapidly that are big companies. It was a big year for tech. And as you can see, here at the bottom, value, both large and small didn't do as well. And you may recall that, as I've talked about with many of you in the Investments 101 class that I give you, over time, value stocks have outperformed growth stocks. Really meaningfully over many, many years. But last year was not one of those years. Last year, growth outperformed substantially value stocks. We include both in your portfolios, although we tend to tilt toward value because of that long-term result. But growth did better last year. And then down here, you can see that the United States accounts for 52% of total stock markets around the world. So again, one of the amazing facts about investing in the public equities markets is that even though we're a small fraction of the world's population, maybe 5%, 6%, our markets remain highly respected. We account for over half of the value of all stock markets in the world. Okay, next, let's see. How do I change the page here? No. Well, it's got me on drawing here, so I've got to go back maybe to, how do I go back to the pointer? Here's the pointer. All right, everybody, I'm just learning the technology. No. All right, let me click page 6. Okay, here we go. Sorry about that. Here's international markets, and a different story in international markets. Look, small companies. Let me get my drawing tool. There it is. Small companies, as you can see right here, internationally did better than small companies in the United States. Again, another reason why we diversify, because you can get all sorts of different effects across the world. And this is a good example where small companies didn't do as well in the United States. Last year internationally, small companies did better. Growth still outperformed value, here it is, but not nearly to the extent that it occurred in the United States. And here you can see that international developed markets accounts for 37, very, very large size, over 1/3 of global stock market capitalization. And then emerging markets, the stocks that did so well, the 37% returns, growth did very well, and value. So in general, what we see is that growth across the board won the day last year. Investors are simply valuing growth right now in a world that was struggling for growth coming out of the financial crisis. Investors are still showing a tremendous amount of respect for growth companies. The flip side of that, of course, is that their valuations are high. And so Todd will talk about that as well. And emerging markets account for 12% of, look at me having difficulty drawing again, drawing right through the text, I'm sorry about that, 12% of the global stock market capitalization. So even though they did well, 37% last year, they occupy a smaller percentage of our portfolios because, for this reason, they occupy a smaller amount of the valuation of global markets. So if you call us and say, hey, give me all 100% emerging markets because they did 37% last year, we're probably going to say, whoa, 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 whoa. They only account for 12% of the global value. Why do you think it should account for so much more in your portfolio? So we'll probably slow you down on that particular item. I'm going to skip a couple. Oh, no, I don't want to skip this. Look at select country performance. The best performing country last year, Austria, right here, 51%. Look at that. Now everybody wants to go put it all and let it ride on Austria. In emerging markets, Poland, 53%. So one of the things we've been hearing in the news lately is all about the political issues that are going on in Poland and the turn toward more of an authoritarian government there. Well, the markets seem to have responded positively to that. Denmark, Singapore, Hong Kong, Netherlands, Italy, Germany, France, Portugal. You see that Europe is quite strong right now. UK, all the way at the bottom here, with a measly 20% return, is the U.S. So you can see that all these countries performed better than the United States last year internationally. And the only countries in these lists that had negative returns were Qatar and Pakistan. Everything else positive across the board. Look at that. Very strong year for markets last year. Next slide. Currency. Last year, we had performance versus the U.S. dollar. Look at the performance of the euro. Up 13.85% versus the U.S. dollar. So we're seeing depreciation in 2017 versus the dollar. That has provided an additional benefit to your international stock holdings, because those international holdings tend to earn their returns in non-U.S. non-dollars in foreign currency. And if the foreign currency that they have their earnings in appreciate, you as a U.S. investor get an additional benefit from that. So look at all the returns, 10 versus the dollar, 13, 13, 10, 10, 10, 8. A period when the U.S., excuse me again, dollar depreciated. And that includes in emerging markets. Look at the Czech koruna and the Polish zloty and the Hungarian currency, the South Korean won, 12.82%, the Malaysian ringgit, 10. So the U.S. dollar, significant depreciation from roughly January of last year, and that has continued this year as well. And Todd's going to talk about the dollar a bit more and what's going on with that. Let's see. Here's REITs, real estate investment trusts. I mentioned to you that global REITs did much better than U.S. real estate did, 15.64, and U.S. REITs right here did 3.76. So your portfolio has benefited from the performance of international. I know that's the theme today. And you see that the U.S. accounts for 58% of global real estate securitization, and the rest of the world's 42%. Let's see. Next, commodities. Kind of a mixed year. Overall, commodities performed 1.7% last year, although that's much better than we've seen over the last few years. You see, over 10 years, commodities have lost almost 7% a year. So not a great time to have been in commodities over these years. Last year, we did have some commodities perform very well, aluminum and zinc and copper and nickel and heating oil. The biggie, of course, is oil, and I'm looking for that. Is that Brent? Where is it? Oh, WTI. Here it is. WTI crude oil, about a 4% return. I'm sorry, I wrote over it again. 4% was the return for crude oil. Not horrible, and we've actually seen oil strengthen at the beginning of this year. Bonds, basically what we've seen in bonds last year was a flattening of the yield curve. So right here are short-term bonds, and these are longer-term bonds, 30-year out there you can see. And so basically the year began right here with a steeper curve because short-term interest rates were still very, very low. The Federal Reserve at the beginning of the year had not begun to raise interest rates or had begun very slowly. By the end of the year, you can see that short-term come up and long-term interest rates had not. And so we say that the curve, and we watch this very carefully. A flat curve is not horrible, but one of the things we watch very carefully is to make sure the curve doesn't do this. If it does that, we have what's called an inverted curve, where short-term interest rates right here are higher than long-term interest rates, and that very possibly could signal a recession. One more slide, and then I'm going to turn it over to Todd. This is the impact of diversification, and you can see going back, it's pretty simple. The more stocks you held portfolio, the rougher the ride was. Here, this dark blue, but the higher you ended. And so that's the trade-off. You have to endure more volatility in order to get a higher return. That is the number one rule of investing: no risk without returns. Okay, I think we're on time. Is that right? And thank you, everybody, for enduring my my penmanship and my cartoon drawing. And without any further ado, I'm going to turn it over to New Capital Management's Chief Investment Officer, Todd Centurino, who joined us in, July of last year full-time, and is working very hard on all sorts of initiatives, rebalancing software, portfolio management, and he is super at presenting. And so he is, you are. No pressure on Todd, he says. So anyway, Todd Centurino, take it away.
Thank you, Leonard, and good afternoon, everyone. I believe my slides are up. So what I wanted to do today was kind of build on what Leonard just illustrated, which was a strong year in 2017, and what we anticipate could happen in 2018 and beyond. And so there are a lot of different metrics that I have used over my career to get a better understanding of the current market environment, and various tools and indices and metrics that I've used to rely on to give me a sense of what the future may bring. But as any forecast, there is no certainty in what the future holds, and that is never more true than in investing. But ultimately, there are many ways we can look at where different metrics are today versus where they have been historically, and then try to draw some inference of where we think they might likely be. So the presentation really will focus on these topics here. First, we'll talk a little bit about global economic momentum, and a lot of these slides, other subjects, a lot of these slides that you'll see, you probably have seen before, either at our call last April, or even during our client event we had in October. And there's a reason for it, because there's a certain subset of slides that I look at frequently to get a sense of where things are, and I think still tell a very good story. And so it's repetition, but it just shows you that we do consistently look at try to look at a lot of the same numbers to see what the movement and what the trends in these numbers are telling us about the future. So global economic momentum will be the first thing we'll talk about. Then we'll talk a little bit about the job market, what profits look like in the U.S., and what inflation looks like. And then we'll talk about equity valuations, talk about interest rates, and then what the different levels that we see today mean for forward expectation of forward returns. We'll make a case for international investments, which I think we've already made a good case, because I think you all have listened well over the last year as we've preached our preference for international investments over domestic. And we'll show just a couple slides on that and kind of why we think that may continue. And then lastly, I wanted to show a historical perspective of inter-year market declines. You know, we've been accustomed to a very strong bull market here over the last 8 years, and it's important we don't lose sight that there is actually volatility in investing in stocks. So we have not seen that, and a lot of that has just been the dynamics that have taken place since the crash in 2008. But we do anticipate that we will see market volatility, and we will see market volatility return. I don't know how many of you know this, but 2017 was the first year ever, going back to 1928, that we had 12 months of consecutive positive returns in the S&P 500. That's never happened before. We've only had 4 calendar years, I should say, where we had a total of 11 out of 12 months were positive. But 2017 was a special year in that every month, was positive for the S&P 500. And unless the market really nosedives the rest of today and tomorrow, it looks like we're on to our 13th straight month. And again, not to lose sight of the fact that there is volatility in the markets, and that it could come, and it could come abruptly. So moving on, again, this is a slide that many of you have seen before, and this is just a slide that shows the Global Purchasing Managers Index for manufacturing, or the Global PMI Index. And this is a very popular leading indicator that surveys the purchasing managers, manufacturing managers across the world on the visibility of their inventory and the visibility of their demand. And a couple things to note about this index. First of all, anything above 50, any reading above 50 indicates an expansion in that particular economy. Anything below 50 indicates a retraction. And what this slide shows is actually goes back to 2016 and actually shows the trend of the global economy. And so the very first line is the actual aggregate global number for the whole world. The developing markets. Is the second. Actually, I'll use my pointer here. Hopefully, you can see this. The developing markets. This is the United States and developing Europe, Australia, and Japan, and then we have the emerging world. And again, going back to 2016 and looking at 2017, so over 24 months of data, we can see that we began 2016 here with most countries above 50, but not much. And the color coding is such that anything in green shows a reading stronger than 50. And as we get more and more above 50, the color coding gets more and more green. And you can see here that since 2016, the U.S., or I should say the world economy, has really been picking up, and growth around the world has been increasing. And you can see that in the colors here. To the point where we are now in December, we had a global reading of 54.5 on the PMI scale. And that's very high. That's the highest we've seen, I believe, since going back to 2011. and we continue to see strength amongst the global economies. And you may have heard this term. It's being thrown around quite a bit now around the markets and different publications. But this is a very highly synchronized global recovery that we're seeing. And honestly, I think that a big reason that we're seeing this now, this is a culmination of everything we saw the Federal Reserves do, the central banks do for the last 8 years, where we saw a lot of quantitative easing, where they were putting more and more money and liquidity into the system. But for many years, we saw growth, but it was relatively stagnant. And now we're really starting to see it pick up across the world. And this gives us a positive outlook that for the foreseeable future, we expect to see more growth, not only in the U.S. but internationally. And this actually sets up a good stage for owning risk assets or owning stocks over fixed income. Is there a question?
Yeah,
oh, we have a question. Okay. Yes.
Yeah, sorry to interrupt. We got a good question. I'm going to have Todd answer it. I'm going to read out the question. What is your strategy to react to a U.S. stock market downturn and its effect on the global market? At this stage of the game, I don't want to ride down the market because I would run out of time to ride it back up again.
It's a good question. So our portfolios are based off of models based on an investor's risk tolerance and time frame. And so that's where we start. And so the portfolios are broadly diversified. Not only we don't not only own U.S. stocks, but we also own international stocks, as you know, bonds, cash, and other investments. And so if we do see a pullback in the markets, our initial reaction is not to overreact, and that's a mistake that a lot of investors unfortunately make in the early onset of a pullback in U.S. stocks. As I get to the end of the presentation, you'll see that we'll go through some of these inter-year drawdowns that we see in the S&P, or historically we've seen, and not to blow the slide, but the average decline intra-year is around 14% we've seen historically. So we should anticipate a market, potentially a market correction that could be in the neighborhood of 10 to 15%. That doesn't necessarily mean it's a down, or we're in a bear market. That said, things we're looking at would be things changing in a slide like we see now with the PMI, for instance. Once we start to see changes in the outlook or the forecasts for economic momentum, that's going to cause us to look at our risk in the portfolio and reallocate our portfolios to make sure that the risk is commensurate with what the opportunity set looks like in the overall markets.
Yeah, and I wanted to add, it's an excellent question. It's something that we think about every single day, literally. It's a great question. I think we want to get through the presentation a little bit more and then take the question up again. What happens if the market falls? And it's a great question. It's one that we look at every day, and I think if we wait a little through Todd's presentation, we'll be in a better position for everybody to be able to think about that question. And I, in particular, will make some additional comments about it. Okay, here we go. Back to Todd.
Okay, so moving on. So what is the unemployment? So looking at jobs, inflation, and profits in the U.S., and we'll start with the unemployment rate. And so this is a slide that shows us the unemployment rate going back to 1968, I believe. The gray line here, this is the unemployment rate, and you'll see that I have it circled. As of November 2017, we're at 4.1%, and that is expected to continue to fall. And really, in light of the most recent tax changes, economists believe this could fall into the high threes, maybe as low as 3.5 or 3.4 over the next 18 months. That would put us pretty close to full employment. It's going to be tough for the unemployment rate to actually get below that. If we do hit 3.4, 3.5, this would be the lowest we've seen since the 1950s. What we're not seeing increase as rapidly is what I have below here, which is the wage growth, and this is this blue line. And what we've seen is I have an arrow drawn here that shows that wage growth is slow. Wage growth has been slow, but it has still improved. It's still improving. If we start to see the labor force continue to tighten, this should have a positive effect on wages going forward. we would expect that wage growth in the form of through labor would have a push on inflation and might have an inflationary effect on overall interest rates. Is something that we'll cover here in a minute. But ultimately, the story right now is the economy is moving at a good pace right now, and employment is strong and may actually get stronger at this point. So what does this mean for profits? And so this slide here, I'll draw your attention to the slide on the graph on the left. And this is just showing the S&P 500's earnings per share. So this is looking at all 500 companies and aggregating their earnings every quarter. And what we can see here is that on these green lines, these are the projected earnings for the S&P 500 for 2018 and beyond. And you can see that earnings are expected to increase. And there's two reasons why, and those are the two graphs on the right side. The first is the dollar. And so what we've seen is that the dollar has been falling, as Leonard had explained in the 2017 review. And a falling dollar actually helps the majority, or a large percentage, I should say, of S&P 500 companies. Actually, on this slide, you can see here the percentage of revenues of the S&P 500 companies that are generated domestically and internationally. And you can see that 43% of S&P 500 companies generate revenue, or revenues, 43% of the revenues of the S&P 500 are generated internationally. So a falling dollar is going to be very, very positive for earnings for the S&P 500. The other tailwind, I should say, is going to be energy sector earnings. So energy makes up about 10% or so of the S&P 500. And now that we've seen oil has surged quite a bit over the last 12 months and is anticipated to somewhat stabilize, the earnings flow from the energy sector is expected to be very positive to overall S&P 500 earnings as well. And so I think it's interesting when you look at this graph and you actually look at the two red circles that I have here, and we go back to the 2015-2016 period where the dollar was very strong and energy prices were very low, as we all know here in Texas all too well. And if you actually look at those two red circles and then juxtapose that onto this graph here, you can see what was happening in S&P 500 earnings when we were just seeing the dollar strong and energy weak. You can see that we actually saw quite a dip in S&P 500 earnings here in this period. And what many people on this call may not realize is that during that time frame, the U.S. was in a recession. We were in what was called an earnings recession, and it was being talked about quite a bit by the market participants. I don't know if it was being talked about as much on CNBC and some of the periodicals, but in my circle and on the calls and the stuff that we look at, it was pretty evident that the U.S. was entering an earnings recession during this period, and a lot of it could be tied to the dollar and energy earnings, and we're seeing that stuff reverse, which is all positive for U.S. stocks. Moving on to inflation, I talked a little bit about wage inflation, but this is more of a broader measure of inflation. But what this graph is looking at is actually going back to the early 70s, or 60s, I should say, and looking at core inflation, which is the gray line, and headline inflation, which is the blue line. And just for those who don't know, the difference between the gray and the blue is the blue line includes food and energy prices, which can be very volatile. And you can see that we saw quite a bit of volatility during this period here, and mostly through energy prices. A couple interesting things to point out, though. Historically, if you look at the long-term averages, even though the blue line is much more volatile than the gray line, their long-term average of about 50 years is very, very close to each other. So what is this graph showing? Well, it's showing us that core CPI actually has been relatively stable. We had a dip here in 2011, but up and since that point, core inflation has been relatively stable. And this is the measure that the Fed is looking at when the Fed is deciding if they want to raise interest rates. They're focusing a lot on inflation, and their goal is to maintain a moderate amount of inflation, not too much inflation and not too little. So you need a moderate amount to keep the engine going, if you will. And the number that they're focused on predominantly is what I have circled here, which is called the PCE deflator. This is the Personal Consumption Index, and this is what the Fed is looking at. And their target is 2%. And so I just circle that and to point out that we're still somewhat below the Fed's expectation of what they want inflation to run at. So we're at 1.8 on the headline and 1.5 on the core. And so as we approach 2% and maybe go above 2%, we'll see the Fed talk a little bit more about their expectation and their outlook for inflation and what that may have to do with with asset prices. But for now, we're still below their target, which should keep them somewhat on the accommodative side. Moving forward to valuations. So this is a slide showing the PE ratio, the price to earnings ratio of the S&P 500 going back to 1990. And I just want to draw your attention to the box. Here, this is showing us where the market is versus its historical averages. And you can see here in the red circle that looking at the price to earnings ratio and other measures like the CAPE ratio and the dividend yield and the price to book ratio and the price to cash flow ratio, these metrics are all showing us that the market is slightly overvalued. The current PE ratio of the S&P 500 right now is 18.2%, and so we're versus the long-term average of 16%. So neither Leonard or I are going to say that the market is cheap. The U.S. market is expensive, but in historical standards, it's not super expensive. It's not overly expensive to the point where we think that the market doesn't have room to grow. We're getting towards there. We're cautiously optimistic, but we still see some positive signs in valuations. One particular metric that's very interesting is what I have in the green box here, and that's looking at the difference between the earnings yield on stocks and the yield you can get on bonds, and that's a negative ratio at this point. And if that's negative, that just tells us that stocks are actually cheaper versus bonds. So to put it in another way, if you have to invest in the U.S. and your choice is to invest in U.S. stocks or U.S. bonds, U.S. stocks still represent a better opportunity and a better valuation than U.S. bonds. That's the best way of putting it. And so it's, again, another metric that we watch very closely and pay attention to. As I said before, we know it's expensive, but we still think there may be some room to go here. So this is a slide that kind of incorporates the PE ratio and what we can expect future returns to look like. So this is a pretty busy slide, and many of you may not be familiar with scatter plots, but this is a way for us to look at the return of two different variables and gather information about what the expectations could be going forward. So if I just look at the left chart here, the only thing I want you to draw from that is that the scatter plot is very, very spread out. And so what this tells us is that over a 1-year period, it's very, very hard for us to determine or draw any inference in what future returns will look like. If we look at the slide on the right-hand side, you can see that the cluster of data is much, much closer together. So we can start to draw a little more information about what we think future returns will look like. And the red line, the red arrow, is showing us where we are today. And the PE ratio is 18.2. And so over a 5-year period, up here, over a 5-year period, when the market has been priced at a 18.2% or 18.2 times earnings, we still can see that the market on average has had a positive return. We don't really, so I'm drawing a line here, we don't really see negative returns until we actually get a little bit further out on the valuation side, closer to 20 times or 23 times earnings, more over 20 times earnings. So that's kind of a valuation level. If you would ask, well, where we start to get worried about valuations on stocks, we start approaching the 20s. Then a lot of these things we look at start to break down and start to give us more data points and more things to look at to say, you know what, how much more room do we think we can go? But going back to what we initially talked about at 18.2 times earnings, we believe there's still some room for the market to continue. Moving on to interest rates, this is an interesting chart. So this is a chart that looks at the Federal Reserve balance sheet, and it goes back to before the crisis, so pre-crisis, and looks at what the expansion of the balance sheet has become because of quantitative easing and all the liquidity that the Fed pumped into the system. And what I want to show is that you can see it grew quite a bit from 2008 up to where we were up to 2018. And so basically it grew from about sub 1 trillion, about 800 billion, to 4.5 trillion. That's a trillion with a T. And so a very big number. And
like Texas.
Yeah, exactly. And what I made a note here, the Fed is going to start to reduce the balance sheet. And what they're going to do is they're going to let $10 billion a month roll off the balance sheet. Essentially, they're not going to reinvest any proceeds, and they're going to start to shrink their balance sheet at $10 billion a month, and they're going to increase that up to $50 billion a month once they get a better feel how the market is anticipating and handles that difference. What I want you to take from this slide here is that this is going to be inflationary, or I should say, it's going to be put pressure on interest rates. The Fed is no longer going to be a big buyer in the market. And so you're going to see a very big buyer leave the bond market, and as a result, prices are going to have to adjust. And the way prices adjust in bond markets are interest rates rise to attract new buyers. So there's a high likelihood that interest rates will rise, and I think this is a big reason why longer-term rates will go up. And the Fed will obviously they're controlling the front end of the curve, as Leonard had talked about earlier, and we think the Fed's going to raise the short end of the curve as well. And so overall, we think rising interest rates are ahead. So what does that mean for future returns in bonds or stocks? So this is another sample scatter plot, much like we saw on a few previous slides, but this is looking at the relationship between rising interest rates and equity prices. And what I did was I drew a yellow square here, a rectangle here. This is kind of where we are today. This is where the range we've seen the 10-year Treasury over the last several years. And what this chart shows us is that as long as the 10-year Treasury is below 5%, then future equity returns, when rates have been rising, have been positive, right? So this is just showing us that, yes, rising interest rates traditionally can have a negative effect on equity returns. You can see all these down here. But it usually doesn't happen until rates get above 5%. And we're still well below that at this point. I think the 10-year Treasury today is about 2.7%. And so, so we still think, even though rates will rise, we still are constructive on the return to equities going forward. A couple more slides here to get through. This is just on the international story. So again, we've harped on this quite a bit. I think this slide captures the gist of it, if you will. So the first is just looking at the box, this green circle here. And this is just purely valuation. Remember, we talked about the S&P 500. The PE ratio of the S&P 500 is 18.2 times. The 20-year average is 16 times. The dividend yield is 2%, and the 20-year average dividend yield is about 2%. Look at the world minus the United States. So this is developed as well as emerging markets. You can see that the world ex-United States is trading at a PE ratio of 14.3 times. Versus their average of 14.5. So they're cheap and actually below historical average. Their dividend yields are much higher, 3.1%, and much just right in line with their overall 20-year average as well. And then the line below just shows historically, going back to 1997, how tightly, how closely the U.S. and the rest of the world traded together. And we saw them trade in a pretty tight band up until this period here. And this was the European debt crisis in the summer of 2011. And then we saw a decoupling, if you will, between the U.S. and the rest of the world, where the U.S. really went on this strong bull market. And the emerging and the rest of the world had positive returns, but nowhere near the U.S. And a lot of the thesis that we base our outlook on, the attractiveness of international stocks, is this I think this chart captures it, is that we don't anticipate this gap to continue to be this wide. Historically, it never has been, and we think this gap will close. And the gap will close one of two ways: either international stocks will outperform U.S. stocks at such a large pace that the gap will close, or U.S. stocks actually could underperform, could be negative, and international stocks could be positive. That is also a possibility. But nonetheless, given the valuation and given the technicals that we're seeing in the markets, we still think we're very constructive that the international markets represent a compelling opportunity, and thus a position that we want to have emphasized in the portfolios. And then just the last slide here, which is what I alluded to early on. This is just a graph showing the calendar year returns for the S&P 500. Those are the gray bars going back to 1980. And the red dots indicate the intra-year decline in each of those years. And then I drew a red line here and calculated the average. So on average, The S&P 500 has had inter-year declines of almost 14%. But if you actually look at what's happened in more recent history, we haven't really seen that. The last time we saw it actually was here in 2011, where it was down 19%. It was actually down 16% in 2000. That must be 2009, I believe. And so this is just to draw your attention to there is volatility in the markets, and we don't want to be complacent. But at the same time, we don't want to look at any volatility that comes back into the market as the sign that this runs over. As we've said, as we've shown on a lot of the other slides that kind of built up into this, we still think there's a lot of positive momentum in the markets, and we don't want to miss the potential returns that are there, given what we're seeing globally in the U.S. From both where interest rates are, from valuation perspective, and then as we talked about on the economic momentum. But we do anticipate we're going to see a little bit more volatility this year, which could make the ride a little bit more bumpy.
And the other thing to note on the slide, and thank you very much, Todd, this is Todd's last slide on the presentation, is you see that most of the years, the gray bars are positive. Right. And so the market delivers and has delivered in the past, can't say it will, has delivered positive returns most of the time. You see that there are a few years here, 6 years or so, where the returns were negative, and of course, especially in 2008, minus 38%. So, okay, a lot of information there, and we have time for questions. So, Catherine's going to read the. I was going to take on that other question, but that's okay. Let's.
Yeah, let me get started. So, before we start with questions, I'm going to open up our other survey. It's an evaluation form of today's conference. If you want to start out. We're going to mute the mics for just a moment. We're going to ask for you to complete the evaluation form. Go ahead and type in any questions that you have at this time, and then we will unmute the mic and answer anything that comes up. We're aiming to finish right at 1 hour, and we will be right back. One moment. Okay, we're back on the mic, and it looks like maybe about half of the people on the call today are done with the evaluation form. Please take your time and finish that up. We really appreciate it. No new questions have come in yet, so please feel free to type your questions in. Still plenty of time. Actually, one more question just came in, but before we get to that next question, Leonard is going to go and address the question that came in the middle of the call. Go ahead.
The question was, what are our plans if the market falls? It's a tough question, and there is no way to answer it in a blanket way. Each of you is in a different financial position. Not one of you on this call today, or any group of clients at New Capital, is the same as another. And that's why we take your specifics and your individual position very, very much to heart. And we spend a lot of time trying to understand what your position is. So the reason we go through the financial planning exercises that are so extensive that we do is because we want to know what your risk capacity is. We want to know if you take a pounding in the market, are you going to be okay and have plenty of money to do what you want to do? So we test your risk capacity. We also test your risk tolerance. We want to know what your psychological predilection is in the case that markets fall. What your reaction is likely to be to falling markets. So we test that. And those two things combined, risk capacity and risk tolerance, helps us get you into a portfolio that we think is the right portfolio. Now, it may change, and if any of you out there think your risk tolerance is changing or your risk capacity has changed, please call us. You are welcome to come in at any time. A lot of these tools now we can email out to you. Not all of them, but some of them we can email out to you, and you can kind of take an at-home test, and we'll get the results of that. So it starts with us understanding what your risk capacity and risk tolerance is. And we are constantly looking for new tools. Todd tested a new product that we really liked last week called Hidden Levers that lets us stress test portfolios even more, and it's got some really beautiful reports where we can show you how your portfolio may react based upon past episodes in the market. What happened in the Great Depression? What happened in this recession? What happened in that one? And so we like the software a lot, and we're testing it. Number 3, a lot of advisors will say, you know, no, stay the course, no, stay the course. We do not have any intention of locking anybody into markets or investments. That's not our job to lock your money up or stand in the way and block the door if you want to sell your investments. All we can do is talk with you and listen to you and listen to your concern and bring the facts out. And today what we've tried to do using data is to bring out where we think the world is, and hopefully you all got a flavor of that even if you didn't absorb every single detail on every single slide. And so we will talk with you at any time to listen to your concerns and give you our input. We want you to be open to our input. The 4th thing I would say is most of you out there are taxable investors. A lot of you have your money in IRAs where it's tax deferred, and we can trade you in and out without any tax effect on those accounts. So that's one issue. We have to look at taxes. Many of you may have some very substantial gains after a bull market's gone for, 9 years or so. And that's a really big consideration, because if the tax on the gains is 25%, you know, that means that we can have a pretty good sized fall in the market before you even come close to equaling. And so one of the things that we are looking at and doing is looking at what the tax effect is. So if somebody comes to us and says, well, I want to sell, we want to come back to some numbers that says, how much do you want to sell and how much taxes are you willing to pay? We want to put a number in front of you or a series of numbers in front of you so that you can really see what the tax bill is going to be, rather than us just talking on the phone and you calling and saying, oh, I want to sell. We really want you to take a hard look at a tax number and make sure that you are willing to pay that price after 9 years of appreciation in the market. One more thing I would say. The index market-based instruments that we use for you are designed for you to be able to hold for your entire lifetime if you are comfortable being exposed to the market for your lifetime. And we think that if there's one thing that you should be willing to hold, any security, it's the market index security. We see companies come and go all the time. Who would have thought Sears would go out of business? And Montgomery Ward's and all the retail companies that are struggling, companies that have had problems. And so the fact that you're diversified, we believe, is a security that you can hold for the long term and should give you additional comfort. Okay, so that's it. Two more questions. We're going to keep going. If anybody needs to drop off the call, that's perfectly understandable. We'd like you to answer the survey if you could before you do so. We'd like to get everybody answering it. Catherine's got a couple more questions that have come in.
Sure. The second one, you may have already addressed most of it. The question is, when it comes to weighing one's own risk tolerance and time of life, should one of those carry more weight than the other? Risk tolerance versus time of life.
Again, everybody's different. So you may be 65 and have a ton of money that can take you all the way to your end of your life, according to our calculations. You know, or you may be 75 and not be in the same position and have less in the way of resources. And so it's really hard to say that what age you are determines where the portfolio should be. We have to take a look at a number of different metrics. It's really the only way to go about answering what's the right portfolio for you. And yeah, there are going to be some similarities, and obviously somebody who's 25 years old's got a lot longer to go. But once people are in their 50s, 60s, 70s, 80s, your individual picture is really going to be determinative. So it's a good question, but there's no simple formula.
Okay, thank you. And as of right now, we've got one more call. Feel free to continue asking questions. We have gone over an hour again. So if you have to drop off the end portion of this, we'll crop it down and make that available in the newsletter. If you have to drop off, no problem. So as of right now, this is our last question, but feel free to continue asking during this period. Tax reform impact on the value of U.S. companies. Thoughts? And I think we're going to have Todd Centurino answer this one.
It's a great question, and obviously it's very timely and something that is top of mind for a lot of individuals. So basically, when you think about what the tax reform bill attempted to do or did, law is law now. You're correct, it's law. It actually took on a lot of different identities as it was going through the process, and the end result actually turned out to be more advantageous to individuals than it was for corporations. Now, which individuals that's more advantageous to is debatable, but about 77% of the total tax dollars that are going to be given back or be given a break for are going to go to the individuals, and about 23% were going to go to corporations. So how does that make its way into the markets? The early estimate is roughly about 5% increase in S&P 500 earnings. So not that much, actually, when you think of it in the grand scheme of things, given how massive this is being touted as being a tax reform. Who's going to benefit most in the U.S. are going to be smaller, domestic-oriented companies. And so the reason being is that smaller companies actually were paying tax rates at a much higher rate, closer to the in the upper 30s, versus if you look at Microsoft or Google or Amazon, their tax rates actually were closer in the mid to low 20s anyway. So their effective tax rates really weren't really benefited too much by this tax cut. It's really going to be the smaller businesses. So small caps should tend to do well in this environment. But more importantly, as I get back to the 77% that went to individuals, the thought is that that'll make its way into increased spending and increased demand. And if you look at the U.S. GDP is about 2/3 consumer spending, actually a little bit more these days. And so the anticipation is that though the increase, the deduction in taxes for corporations won't affect them from a tax rate standpoint, but it could actually increase revenues, and that could be very positive for equity prices going forward. The biggest issue, though, all the positives talk about, the biggest thing that is not addressed enough is that this was essentially financed through the deficit. So it's got to be paid back again, and that's the big problem. Is that this is going to be likely a short-term kind of shot of adrenaline to the markets. I think we've seen the markets react on that this year. I mean, I don't know how many of you have been paying attention. I don't know what the market finished today. It was down, but going into this week, we were up almost 8% on the S&P 500 year to date. So the first month of the year, really, really strong returns. I think a lot of that is anticipation that this adrenaline is going to be thrown into the economy. Unfortunately, it's going to be relatively short-lived. And economists that I follow anticipate that U.S. GDP could grow north of 3% for this year, but largely it's going to be a 3+ GDP growth for 1 year, and then followed by a series of mid to low 2s. And a big reason is that it's just not going to be sustainable. A, because it's been financed to the deficit, and B, we didn't talk a lot about we can tie it into labor force, but if labor force growth doesn't increase, we don't have more labor, then GDP growth is actually going to be constrained, and there's not going to be enough workers to increase productivity over that 3% hurdle. So, a long-winded way of saying positive in the short term for U.S. companies, moderately negative to mediocre going forward from there.
And I wanted to add to it, I agree with everything that Todd said, maybe with the exception of one thing, but the markets have already priced in the tax cuts. The markets respond immediately to known information, which is one of the reasons why we are market-based investors. And so we've seen a rise in the market based upon what happened with the tax law, and that really indicates that there's been an enormous benefit already to U.S. shareholders or to shareholders in U.S. publicly traded corporations. That has already occurred, and I think that really explains a lot of what's gone on here in January. I could be wrong, but that's, to me, the market responding to that. And so it was a really huge cut in corporate taxes that occurred. Todd is right that 70+% of the total aggregate dollars went to individual shareholders, but that's being spread over a much larger base. That's being spread over the entire U.S. population versus the collection of U.S. shareholders, which is a smaller subset. And so if you send 25% of the benefits to a relatively small group of U.S. shareholders versus 75% to the entire population, it is, in my judgment, overweighted toward U.S. shareholders. And of course, the changes in the estate tax have been very dramatic, a doubling of the threshold. We could talk about this law on, and I think many of us don't even know. However, the initial indications that I've heard from people getting withholding in their paychecks and so on is that they're seeing a little bit of benefit from it. And Todd's nodding in agreement. Okay, so that's it. No other questions have come in. Cal, I'm going to turn it back to Catherine to bring us to a conclusion. Thanks, everybody, for joining us today.
I was just going to add, if you have any questions that come up after today's call, after we end the call, just about now, feel free to email or call any one of us. We can get the answers for you. And that's it. Thank you so much to everyone for joining us today. We appreciate you being here, and we hope you can join us on the next call as well. Everyone, enjoy the rest of your day. Thanks so much.